With me is Jeremy Millar, which is a Chief Development Officer at Consensus. And I'm really happy to have him here to talk about fundraising and startups and some other things. So hi, Jeremy, how are you?
Yeah, all right. So I'm just going to comment on the biz dev panel. All right, business development is not about networking and relationships, okay? It is not about empathy. It is not about loving your customers. It is about understanding two things really, really well. What is in it for you and what is in it for them? And if you cannot answer those two questions in 3 bullet points in a super compelling way, you will not form a commercial relationship with any partner. And typically, any contract negotiation, any significant commercial agreement in Web3 or any other industry comes down to fundamentally understanding what do we want and what do they want. And most companies that I do business with, when they go in to negotiate, have not thought that through nearly well enough. So put aside networking, put aside being nice. Those are good things to do. Be nice, go and network. But when you go and talk to someone, understand why would they want to do business with you and what is the real benefit that they're going to get from the relationship and what is it that you want. And everything else is tradable. Everything else you can trade away, so long as you're getting what you want and they're getting what they want.
So amazing. I think we jumped straight to it. And so maybe we can start with Consensus and a bit about you. What is your background and what are you doing in Consensus today? And kind of maybe how did you get into crypto?
Sure. So in the 90s, I was at a big software company called Oracle working on a programming language called Java. And then I went to business school, and in business school has a good way of brainwashing you. So I was an investment banker at Goldman Sachs for a number of years, and then went back into tech, and in 2015 was starting to look at Bitcoin and blockchain, and I wrote a big research piece on the space that we published, and I think was viewed something like 300,000-400,000 times that year. And I talked to every company in the space and decided I was going to go do it full time, and ended up hanging out with several of them and deciding that Consensus was the best fit for me.
Got it. So you kind of have the background both of engineering and software development, but you also did banking, so you kind of know both worlds. And today in Consensus, what is your core focus?
Running Consensus. I think my number one job is providing senior leadership to the company, and then my functional role is I run sales, business development, and fundraising and M&A, and most of our commercial strategy.
Amazing. So Consensus is one of the largest organizations in the space and on Ethereum. So you kind of have this side about everything that is going on. So I really want to pick your brain about how do you see fundraising today? And maybe we can start, with the last 3 years, because they were kind of crazy. So how did the last 3 years since COVID hit you? What did you see? And then we can jump maybe to the current fundraising landscape.
Our business goes in cycles. It's all driven, price up, then everything else up. So it's super easy to raise money at the peak, and it's really hard to raise money. It was really hard to raise money the 2/3 of the way through last year. I think the first thing you need to understand about our industry is it's incredibly cyclical. Not like business cycle cyclical, but crypto seems to run on 2-year cycles, right? So, that's the first thing you just need to understand. When ETH is at 5,000, it's really easy to raise money, and when ETH is at 80, it's really hard.
And do you think, by the way, about the 2-year cycles? Do you think it will continue, or is it just a thing? Because you can kind of, you had about, I think that was the 4th crypto cycle, right? And a lot of people kind of think that, it was correlated to what happened in financial markets and everything. And now we're asking ourselves, well, will it be the same thing? Like we're going to see another cycle in 2 or 3 years or 5 years, or like how do you think about that?
I mean, our expression internally is higher highs and higher lows, and that we think the cycles are getting shorter. I don't know if there's any evidence of that, like real evidence of that, but our belief is there's enough activity that the cycles are shortening. And this down cycle, like 900 was the low, sort of 1200 typically. So like it didn't go to 80, it didn't go to 500. So, I think it's certainly, it's evolving. It's not, but yeah, I think we live in there's a lot of speculation in crypto. What do you want to say? I mean, I think what you need to do is you need to understand that has to fundamentally be part of your business model. In crypto, you make money in the upcycle and you survive the downturn, right? So just like plan accordingly, take money off the table at the top. And when you have a big retrenchment, like cut costs.
And so it's interesting. So you kind of, you've built a lot of your thought about the different cycles. That's how crypto works. It's interesting for me. Like, what do you think about DeFi? Because like the last cycle, 2017-18, it was the ICO bust, and then, we didn't have most of the stuff we're seeing today, right? So the ecosystem is much richer than it was. So how do you think about DeFi and what's been happening with all of the explosion in startup in the last few years?
So the downside of DeFi is liquidations, right? Like when there's a crash, like watch out, right? You can see it, right? Like, so what happened in this cycle is, so why didn't ETH go below 1200 when FTX blew up? Everyone had been wrecked, right? Like everyone got called out in April, right? Like just go back and do a chart of maker liquidations, right? The reason why ETH didn't go into free fall after FTX is everyone got liquidated after Celsius. And so this time around, people were way more careful and more over collateralized. Plus, like, everyone had already been forced to sell. So like DeFi's great, but so far, right? Like it's arguably added to volatility, right? Because, automated liquidations.
Yeah.
And DeFi adds leverage to the system.
Yeah, and it's interesting you mentioned FTX. I'm sure it was very interesting for you to see that, like the fast rise of FTX and the fall. So how are you looking on FTX from Consensus side? Like, did you like it at the beginning with, like, what did you think about SBF? And
so I think so first, FTX was a good business as an exchange. If Sam and the team had focused just on running FTX, they were like, the thing was profitable, right? The problem was, I think everyone well understands, like, how poorly managed it was. But the issues in FTX first started appearing during the whole 3 Arrows Celsius stuff in April, March last year, right? Like if you, I'm not sure how public or not it is, but I mean enough people were in there. There were some really large positions that you could see, right? In the 3 Arrows in the 3 Arrow liquidation, you could see that there were some very large, although the full loan book wasn't disclosed, there was a whole bunch of stuff that became visible during that process that made it clear that there was a lot of FTX being used as collateral. And the only way that much, FTT being used as collateral, and the only way that much FTT could be used is, if it was Alameda and FTX doing it themselves, right? And so, a couple of weeks, maybe when was ETHSF? ETHSF was like the week before, right? Like CZ did his thing on the Friday during ETHSF, right? And I remember I was at a lunch with some investor who had been in, the 3 Arrows Celsius BlockFi mess, right? Because that's when all this stuff really started to being discovered. The reason why like the balance sheet stuff, and Ian was able to write his article. Like a lot of this stuff became discovered through all the bankruptcy proceedings around Celsius, 3 Arrows, and BlockFi, right? Because a lot of the collateral that got messed up there was FTT backed, right? And so there was a group of people sort of who there was like a sort of an insider bet within some of the like really informed investors of like, will FTT blow up or not? And, so that was sort of like within a medium-sized group of investors, like I think any of the sophisticated crypto investors were aware that there was risk in it before Ian published his article. And I think like a lot of the ways that Ian was able, I suspect, I haven't talked to him about it, but I suspect like a lot of the information that fed into the article that made it onto CoinDesk came out of the discovery that happened around Celsius, BlockFi, 3 Arrows earlier in the year.
Yeah. So that's a very interesting point of view, by the way, getting it firsthand. And maybe we can jump to talk about kind of current landscape and what is interesting today and what is going to be interesting the next 2 or 3 years. So if you look on the crypto industry today, and there's a lot of stuff going on like altchains and rollups and ZK technology and DeFi and gaming. So what do you find the most interesting today amongst all these different verticals and things?
I think they're all interesting. I mean, over the last 12 months or so, gaming has probably seen the heaviest amount of investment in crypto. That doesn't necessarily mean it will be the next big thing, but there are a number of like $100 million plus AAA production games that will have integrated, NFT and crypto functionality or NFT and wallet functionality coming out over the next 12 to 18 months because they got funded at the peak last year. So, app-specific chains are a thing. I mean, I think one of the things that we are really focused on is like what's going on in the ZK ecosystem and ZK scaling solutions. In terms of, the challenge on consumer is it's really hard to predict hits, and consumer is a hit-driven business, right? Like you don't know what's going to be a hit game. You don't know when social's going to take off. I mean, Twitter was literally bankrupt, right? Like not when Elon bought it, when Twitter was launched out of the prior company, right? Like Ben and the guys, Biz and the guys, like literally were in the office, right? They tell this story publicly about how they were considering shutting there was a precursor company to Twitter, I forget the name. They were considering shutting it down, right? Putting it into bankruptcy. They drew up the UI for Twitter literally on the back of a napkin or on a piece of paper, coded up as a prototype, and saved their company, right? Like, you just don't know, right? And so, like, that's why it's really hard to call, like, is it going to be NFTs? Is it going to be like a hit video game? Is it going to be Lens? Is it going to be, like, you just don't know. Like, someone is going to do something at the right time with the right people that will blow up. That is predictable, but what and when is much, much harder.
Got it. Yeah, it's sort of like Hollywood movies, right? Betting on the right movie in the consumer space.
And so Hollywood stopped making movies and started making sequels. Right?
Yeah.
Hollywood now produces franchises because the individual hits business is too hard, and the people who can do hits are the people with the data. So Netflix can take more risks.
Mm-hmm. Yeah.
Because they've got better data.
Yeah, super interesting. So maybe we can also talk about a bit about tokens in the time we have left. There's been a few interesting things going on, specifically this week, if someone has noticed. So there was a big Uniswap vote in which kind of A16Z, which are the largest token holders, voted against an integration of Wormhole into the BNB chain. And there were all sorts of kind of accusations, and people said, hey, there are big stakeholders in the platform, but they also they have misaligned incentives because they also invested in the competitor of Wormhole. So how do you think about tokens today and governance and all of this world?
I mean, A16Z was pretty transparent. They said if we could vote all of our, this isn't a direct quote, but they said if we could vote all of our tokens for layer 0 and against Uniswap, we would, right? Or against Wormhole, we would. They were pretty explicit. I don't know. Were interests misaligned? I think A16Z acted completely in their interest. I think what it says is you need to be, you need to be really careful about who's in your cap table and who's in your token table and how these things are distributed, right? Yeah. And then you need to be careful about the votes, because I think on Uniswap, it only takes 4% to block. Is that right? Right? You don't need that big a chunk. You need a big chunk to pass, but you don't need a big chunk to block, if any, right? So, maybe that wasn't the best governance design. Maybe you need so we're going to learn, but I don't think the behavior is sort of entirely predictable. A financially motivated institution did something in order to increase their financial gain. That's kind of predictable, right? With all due respect, that's what funds do. Go look at Elliott Management. Go look at, or go look at any activist investor. By the way, Elliott Management is a really effective, well-run hedge fund that focuses a lot on corporate governance. So I'm not saying Elliott is a bad actor, because they're not. They're a good actor, in my opinion. But this is what activist investors do. So I don't see the behavior as at all surprising. It just maybe it does say that we have a lot to learn about governance, and we're going to need to get smarter about it.
And do you think we're going to go to the world of, so corporate governance is quite developed, right? It had 250 years of development naturally in the markets and regulation and everything. So you think we will go towards that direction? Because a lot of people said, so we were in Web 3.
Traditional corporate governance is backing the management team. And the difference here is you're doing direct votes on management decisions, right? Mm-hmm. And so if we're going to have more of that, I think we're just going to need to be, people are going to need to be more thoughtful about the rules.
Yeah, so maybe kind of different layers and delegations and stuff like that.
Uniswap has delegation. The issue that they ran into is it didn't take a very big chunk. It didn't take a very big chunk to block something that most people sort of wanted.
Yeah, it's interesting because you have sort of a collision between, people who are saying more of crypto and they expect everything to be decentralized, but, the world is kind of centralizing even in crypto in certain points. And you do have maybe for the first time these big entities that have a lot of capital. So I definitely think the next few years around that will be very interesting. And I think we have only a few more.
We haven't talked about fundraising at all.
Yeah, we kind of got dragged, but maybe we can talk about fundraising right now. So how do you think about fundraising today for startups, right? The market is kind of tough. Everyone are licking their wounds.
It depends on stage. I guess most of the organizations here are most of the people here are probably more focused on early stage. I think, so I think it very much depends by stage. You can still raise money today. Valuations are just down a lot. The bar is higher. You probably, there are certain teams, certain first-time teams, that probably, there are ideas that could get funded a year and a half ago that won't get funded today. But if you were the strongest teams can still raise money. I think if you're at any level of, if you're at $10 million plus of ARR, you need to have a path to profitability, and you need to show that you can go 2 to 3 years on whatever round you're raising. I think there's a much greater focus on metrics. People are going to be much more. People are going to go way beyond headline revenue. So, in a year and a half ago, a year ago, revenue was going up so quickly, multiples were really high, so it was easy to get a round done. Today, people are gonna drill into what's your LTV to, if it's a SaaS or SaaS-like business, what's your LTV to CAC? How are you thinking about your runway? they're going to be drilling in a lot more into retention and churn metrics, because if you don't have a lot of growth, then retention and churn are really important drivers of profitability, whether it's a transaction thing or a recurring revenue business. So the bar is higher. There's a general concern that the second half of this year is going to be really problematic, because there's a bunch of companies that raised 2 years of runway at the peak, and that 2 years expires in Q3, Q4 this year. So there's going to be a whole bunch of startups coming into the market in Q3, Q4 this year that have run out of money. Cut deeper, cut earlier is my general advice to startups going through a downturn. Take money now if it's available to you. It's gonna get harder, is the general view. Like, the general view is from a macro story, right? Like the U.S. macro the U.S. macro backdrop is first half good, second half bad. But then from a VC funding perspective, the view is, there's going to be all these companies that need to raise money towards the end of this year, and you don't want to be one of those companies, right? Because even if you're a company that will get money, the terms are going to suck. So take money now if you can, would be one piece of advice. And, really, you're going to have to know your metrics inside out, and you're going to need to be able to justify where the money is going and why. And you're going to need to have some sort of story about how you're not going to need to come back into the market in the next 2 years.
Yeah, fascinating. And do you think, like, most of us, I'm guessing, haven't lived throughout the dot-com bubble or 2008 maybe? So do you think it's going to be something of that extent, or is it just 1 or 2 years and we're gone, right?
I don't know. I mean, cycles are pretty quick. What we're experiencing, I think there were really different views on this, because you have the whole sort of like CFI destruction that sort of happened, right? The dot-com bust was, from my perspective, far more dramatic, because it wasn't just dot-com bust. It was 6 months later, 9/11, right? And so it would be sort of like if it was FTX, Celsius, Three Arrows, Genesis, DCG, FTX, and then 6 months later you had COVID. Right. And so, fortunately for us, that it happened the other way around. So it's not going to be that. So I don't think it's really comparable to that. And the other thing that's happening, at least in our space, is actual activity remains high. Right. So gas is going up. Right. Like gas fees on the Ethereum network. Drew and I were looking at this morning. Gas fees are going up, right? Gas was at Drew, what were you saying? It was a couple months ago, gas was at 12. Now it's at 25, right? The network's pretty busy, right? There's a whole bunch of useful things in Shanghai and 4844 and what have you. There's a lot of things happening. There is still, NFTs might be down 90%, but there's still a lot of NFT activity. There are lots of games that are coming onto the market. So I don't know. I think it's its own unique thing. I don't think there's really a comparable. And from my perspective, no, it's not as bleak, certainly, as 2001 or 2008.
Got it. I think we're almost about out of time. Yeah. If anyone have, maybe one question from the audience. If anyone has any questions, yeah, sure. You can go into the audience.
So I'm going to describe what I feel like is a little bit of a typical Ethereum project situation at the moment, maybe early stage, raised token-based in the last year or two, then probably also distributed some tokens publicly as an airdrop or something along those lines. Token is down bad. Now there's I feel like there might be some kind of disconnect between implied valuation based on the token, but versus maybe general.
There's a bunch of people who wish they didn't have tokens now, that's for sure.
Yeah, so I'm not even sure what the final question. How do you see this kind of situation? How do you see those projects? I guess a lot of projects in this situation at the moment.
Yeah, I mean, I think When Token is like at least a year and a half ago was a key fundraising tool and a key tool for the community and what have you, right? But there's no doubt there are as many projects out there that wish they didn't have a token that do, right? Because once you have a token out there, even if your project's doing pretty well and the token down, yeah, it's tough. Like, what's your investment story? And so I mean, it's going to be interesting to see what happens. I think, we look at companies to buy all the time, right? Like one of the things my team does is we do acquisitions for the company. And so you'll find a company that might have a feature that will fit really well with MetaMask or Infura or what have you, but they have a token. And all of a sudden, like, not only do we have to like figure out, do we want to buy this company and what have you, we have to figure out how we're going to get rid of the token. And so like similarly, if you've raised a round and your plan is, we'll raise one round and do a token, then our treasury will be so massive, And so you've distributed your token to your VC investors, and now you would need to do a down round. Like I don't know. People are gonna have to figure that out. But I suspect there are as many projects with tokens who wish they hadn't than had, because. Certainly in a down environment, like it can be an anchor as much as it was like, part of the rocket that would take you to the moon during the up.
You have some kind of piece of advice to this kind of project?
I don't know. What would I do? What would I do if I had a project that needed? So. What would I do if I had a project that had a token that was way down and I needed to raise money? I would allocate some of the funds to a token buyback probably. And I would really, really focus on what my token story is going to be going forward. I would probably, if it's down, consider diluting the heck out of my current holders, because that's what's going to happen to your equity holders. And like everyone's going to be so upset that token down anyway that like if you can get a round done, token, maybe it's helpful. So like I'd consider doing the same thing that you'd do in a down round for equity, which is dilute. And then redistribute and, try and come up with like something really to do with it. Like, how many tokens out there were like an exit strategy versus an actual integral part of the, all right, everyone's laughing. So there's your answer, right? Right. So like, I guess the answer would be if you've got a token that's down and you need to raise money, you better come up with a really compelling story for your token, right? That actually makes it an integral part of your product and your community. And if you don't do that, then it's going to be even more challenging.
Yeah, maybe one last thing from our side. So one of the things we do at Collider, so we actually buy tokens for very specific projects. So we did it like 3 times for our last fund. So when we find some project that, they have enough cash and we believe there's an actual use case and it's a great project. So some of them, it's funny because some of them are really amazing projects with some amazing founders. And we find it to be an opportunity. So it might be also some kind of a strategy, try to find the liquid funds that will invest, and if you have actually value accrual for the token, that's
yeah. I don't think CowSwap's in trouble.
Yeah.
This is
go fix that. Go fix the smart contract.
All right. So thank you so much for Jeremy Millar from Consensus. This has been a great talk.